Dave Ramsey has convinced millions of people to pay off their mortgage early, but this advice is costing them hundreds of thousands in wealth. Mortgage debt is good debt when used correctly, and paying it off early is actually financial malpractice. Welcome to Retire Rich. I'm your host, and today we're diving deep into strategies that can transform your financial future. If you're serious about building wealth, you're in the right place.
You know, from the moment we start thinking about money, we're sold this dream, right? Own your home, free and clear. It's supposed to be the absolute peak of financial security. But here's the thing. This dream, it has a hidden and frankly dangerous flaw. What if that very strategy, the one that's supposed to make you feel so secure, is actually the anchor holding you back from real financial independence? Seriously, think about it. What if all that equity you're so proud of is just a sleeping giant trapped inside the walls of your house, doing nothing for you?
Now, don't get me wrong. The emotional pull of being completely mortgage-free, I get it. It is incredibly powerful. It's this idea that's just baked into our culture, right? The vision of a life without that huge monthly payment hanging over your head, it's a powerful one.
In that feeling, it's all about absolute safety. The idea that no matter what happens, market crashes, you lose your job, some crazy crisis hits, you'll always have your home. It's your fortress. And that psychological comfort, that's the real product they're selling when they tell you to pay off your mortgage early. It's a huge motivator for sure, but let's call it what it is. It's an emotional decision, not a financial one.
So, this is where we have to make a hard pivot. We got to switch from feeling to finance, because that sense of peace, it comes with a real quantifiable price tag. And trust me, when we look at the numbers, a totally different picture starts to emerge. If you're serious about building wealth, you've got to separate your emotions from your spreadsheets. The numbers, they don't care about how comfortable you feel. They only care about efficiency and growth.
You see, every single financial decision you make is a trade-off. Choosing to throw an extra $1,000 at your mortgage isn't just a move to lower your debt. It is, at the exact same time, a decision not to do something else with that money. Every single dollar you prepay is the dollar you've yanked out of the wealth creation game and locked away where it can barely grow. And this brings us to what might be the single most important concept for any serious investor: opportunity cost. Think of it as the invisible price tag on every choice you make. It's the ghost of the money you could have earned. So by choosing the safe return of paying down your 4% mortgage, you are actively, consciously sacrificing a much, much larger potential gain somewhere else.
So here it is, the fundamental math behind this whole argument. It's actually super simple. On one hand, you've got your mortgage, probably sitting at an interest rate somewhere between 3 and 5%. Paying extra on that loan, that gives you a guaranteed, but let's be honest, pretty tiny rate of return that's equal to your interest rate. Now, on the other hand, you have the historical average return of the stock market. We're talking decades of data here, stuff you'll find in any classic finance book, showing it's consistently been around 9 to 10% over the long haul. You're literally choosing a 4% return when a 10% return is on the table. That gap, that is where fortunes are lost.
And this right here, this highlights a massive difference in how wealthy investors think about debt compared to the average person. See, most people see debt as this disease, something to be wiped out at all costs. But the wealthy, they see certain kinds of debt as a tool, one of the most powerful tools out there for cranking up the speed of wealth creation. They use leverage.
Because here's the secret. Not all debt is created equal, not even close. Bad debt, that's your high-interest credit card debt, your car loan. It's for stuff that loses value. It's a total wealth killer. But a mortgage, that's the textbook definition of good debt. Think about it. It's a huge loan at a low fixed interest rate, and you might even get to deduct the interest on your taxes. It lets you control a massive, appreciating asset, your house, while keeping your own cash free to go out and work for you in investments that can generate way, way higher returns. It's literally using the bank's money to get rich. You know, this isn't some new idea. There's this ancient wisdom from the richest man in Babylon that just nails it. It perfectly captures the whole point of investing. Your money should be your army. Every dollar is a soldier you send out to capture more dollars. So when you prepay a low-interest mortgage, what are you doing? You're pulling your best soldiers off the front lines and locking them in a barracks where they do absolutely nothing. You're trapping your capital inside your house, where it just sits there, instead of putting it to work in the markets where it can compound and build you a real fortune.
Let's make this crystal clear. We're going to compare two people. They're both disciplined, and they both have an extra $500 a month to work with. Their discipline is exactly the same, but their strategy, well, their strategy is worlds apart, and this is where the cold, hard reality of this choice just becomes undeniable. Okay, so here's the setup. Investor A sticks to the conventional wisdom.
Every month, they diligently send that extra $500 to their mortgage company, feeling all responsible as that loan balance goes down. Meanwhile, Investor B takes that very same $500 and invests it month after month, no matter what, into a simple, low-cost S&P 500 index fund. They're just buying a tiny slice of the 500 biggest companies in America. See the difference? One path gets you debt-free a few years early. The other path, that one leads to building actual life-changing wealth.
And just look at the results over 30 years. The outcomes aren't even in this same universe. Investor A, our mortgage prepayer, saves a nice, respectable $75,000 in interest. Not bad, right? But Investor B, the one who just let their money work for them in the market, has potentially piled up over $500,000. We're talking about the exact same monthly savings, but one strategy gives you a result that's 7 times bigger. That is not just a different result, my friends. That is a different life.
And what's really crazy is how this gap just widens exponentially over time. It's the magic of compounding. Look here. After 10 years, Investor B is already ahead, looking pretty good. But then, look at year 20. That's when the power of compounding really kicks into high gear. Investor B's money isn't just growing anymore. It's creating its own earnings, which then go out and create their own earnings. Investor A's extra equity? It just grows in a straight, boring line. But Investor B's wealth, it's on this explosive upward curve, accelerating every single year. One person is building equity. The other is building a dynasty.
Okay, I know what you're thinking. But what about the risk? That's always the immediate objection, right? People are terrified that the stock market is just a giant casino. And that, right there, is a fundamental misunderstanding of what it means to be a long-term investor. That fear comes from treating a decades-long journey like a weekend trip to Vegas.
You got to listen to the master, Warren Buffett. His whole philosophy teaches us to think like business owners, not like frantic stock traders. When you invest in a broad market index fund, you become a part owner of hundreds of the most successful businesses on the planet. You're not gambling. You're betting on the long-term growth and innovation of the entire economy. The daily, minute-by-minute ups and downs of the market, that's just noise. Ignore it. You're in this for decades, not days.
And the historical data backs this up. It's incredibly clear. Fact 1. Over any 20-year period in its entire history, the S&P 500 has never, ever produced a loss. Fact 2. As guys like Vanguard's founder John Bogle proved, simple, cheap index funds consistently beat the pants off the vast majority of high-paid Wall Street pros trying to pick stocks. And fact 3, the simple strategy of just investing the same amount regularly, that's called dollar-cost averaging, it automatically manages your risk. When the market is down, your $500 buys more shares. When it's up, it buys fewer. It's a system that forces discipline and takes all the emotion out of it.
So we have to completely redefine our end goal here. The whole point of money isn't to have a perfectly clean balance sheet on the day you die. It's to fund the best, richest life you can possibly live. True financial freedom, it's not the absence of a mortgage payment, it is the presence of capital. It's having a wealth-generating machine that gives you options, flexibility, and the real power to live your life completely on your own terms. A paid-off house with nothing in your investment accounts, that's just a gilded cage.
So I'll leave you with this question. What is the real price you're paying for that peace of mind you get from an early mortgage payoff? Look, in the end, this isn't about being smart or stupid. It's about being informed. The real price you're paying could be a retirement that's delayed by a decade. It could be a lifetime of missed opportunities and literally hundreds of thousands of dollars in wealth you just never built. Understanding this powerful alternative of investing isn't just an option, it's your responsibility. That's a wrap on today's episode. If this helped you see money differently, smash that like button, subscribe to Retire Rich for more wealth-building strategies, and drop a comment telling me what topic you want next. Remember, your financial freedom starts with the choices you make today. I'll see you in the next one.